Good morning, everybody. My name is Chris Thomas. My firm is 40W Advisors, and we have the privilege to serve as the retirement plan consultants on your company's 401k plan. Today is January 18th, and this is our January monthly wellness webinar, first webinar of 2024. So happy New Year to everybody. Today, we are going to take a look back on the investment markets in 2023. We're going to review some important reminders about managing investments for retirement, into the future, into 2024 in particular. So thank you for joining us. For those that I have not attended before, my name is Chris Thomas, as I said. Firm's 40W Advisors. We work with your company's 401k plan. And as part of our work with your 401k plan, we provide education in a number of different forms, but one of the ways that we do it is through these monthly webinars. I encourage you to check out our website, 40workplace.com. That'll take you to the section of our firm's website that is set up specifically for employees like yourself to get some more tools and resources that you can use to manage your overall finances, not just your 401k plan. We're also becoming more active on our social sites where we're going to post new blogs and writings that we do, as well as reminders for webinars like these every month. So I encourage you to check those out. A little more housekeeping before we jump in. Everybody's currently joined in listen-only mode. If you do have any questions, please type them into the questions box or the chat box that are here, and I'll be sure to get to them. I'm flying solo today. I don't have somebody else monitoring those, so I will periodically jump in and check those as I'm speaking. If not, I'll hit on them at the end. So let's go ahead and get started. Here's how we're going to tackle things today. We're going to start by looking back. 2023 market returns, which were very favorable, positive returns on the year after a really difficult 2022. Then we're going to recap, go a little deeper into 2023. We'll recap some of the good and the bad that we can take away from it. And then finally, we'll wrap up with 3 keys to retirement investing in general, some of which I think are particular to 2024, which, as you know, we are in a presidential election year. So here we go. Looking at 2023. After a very rough 2022, 2023 turned out to be a great year for investors. Both stocks and bonds generated positive returns. Starting on the left here, you see that large cap US stocks measured by the S&P 500 led the way, generating returns of 26% on the year. The majority of those returns in the traditional S&P 500 index are attributable to just a handful of the largest companies that really had an outsized return, mostly in the first half of the year, on the back of what was some euphoria around artificial intelligence. We're going to talk a little bit more about that in a few minutes. Heading into October, the divergence between the S&P 500 and everything else was really extreme. But the real story for me on the screen here is that what we saw in the fourth quarter, we saw other parts of investors' portfolios started to rally in the fourth quarter. Most of the returns from the small cap stocks measured by the Russell 2000 index, most of those returns came in the fourth quarter, with the index for small caps ending the year up almost 17%. The same is true with stocks outside the US. We saw stocks outside the US were up 15% on the year. Most of those gains coming in the fourth quarter as well. Same is true with emerging markets international stocks. Emerging market international stocks, as were bonds, were both negative heading into the fourth quarter, but generated all of their positive returns in the fourth quarter, making them post positive returns for the full year as well. Emerging market stocks up 7%, bonds up 5.5%. So positive year across the board for investor returns. And As I know, most of the people on the call, most of investors in 401k plans are invested in target date retirement portfolios. As a reminder, target date portfolios are professionally managed all-in-one portfolios. When you invest in a target date fund, your money is going to be diversified into different types of investments based upon your time horizon until retirement. So someone with a longer time horizon is going to have more of their money allocated to stocks. We'll talk about why towards the end. So for example, if you are invested in the 2060 portfolio, you are expected to retire around the year 2060, which means you are likely not going to need to tap into your retirement savings for another 35 years. Your portfolio is probably then invested almost entirely in US and international stocks, as you can see by the example, on the screen here. As your time horizon gets shorter, your allocation is going to shift more to bonds or fixed income investments, which have historically been much more conservative. So every target date fund provider has their own methodology for how they determine their allocation. So this is just an example that you see on the screen using the Morningstar Moderate Target Date Index. It's just an index of target date funds in general. But whether you're with, Vanguard, Fidelity, American Funds, Principal, every target date portfolio, every target date portfolio manager is going to have a little bit of a different flavor for how they do these allocations and how they invest within those allocations as well. But as you can see from the portfolios on the screen, those are the larger stock allocation, the longer dated 2060, 2045 portfolios. They returned over 17% in 2023. While those closer to retirement, maybe represented by the 2030 portfolio here, had returns around 13% in 2023. I don't think either of those, double-digit returns or anything to sneeze at. As I said, it was a great year for investors in 2023. So let's dig a little bit deeper into 2023 by touching on some of the positives and negative takeaways that we might have from the year. So let's start with the positive. Investors might say the best part of 2023 was really the unexpected double-digit rally that we saw in global stocks. As I saw earlier, the World Stock Index posted its best year in 4 years, with every major region posting a positive gain. What we also saw in 2023 was a rally in fixed income or bond investments. They typically don't get enough attention. And the rally in the bonds came following the worst year in history. 2022 was the worst year in history for bond investors. 2023, both high yield and investment grade bonds had their best year since 2019. And that was all despite rising interest rates, which for the most part of the year, which we saw through the Federal Reserve and was due to inflation. So as you can see on the screen, and this is really what I wanted to dive into here, as you can see on the screen, prior to November of 2023, bonds had experienced 6 consecutive months of losses. That was the first time in history bonds had 6 consecutive months of losses. Again, this was all happening as a result of high inflation. The Federal Reserve was hiking interest rates, and therefore, we saw an increase in bond yields altogether, particularly the 10-year Treasury rate, which spiked up to 5% in October. But in November, after we saw some signs of that inflation was cooling, and the Federal Reserve paused its interest rate hikes, and even started to fuel some speculation that there's going to be the Federal Reserve will start to cut interest rates in 2024, we started to see a bond rally in November. So November and December produced the best 2-month returns for bonds dating back almost 100 years. So the last 2 months of returns in 2023 for bonds were up, 8.5%. So historically, that's resulted, when looking back at the top 10 2-month return periods, so that's taking the other top 10 periods where we saw positive 2-month returns. Historically, that means that we've seen 1 year performance following that to be pretty positive. So it's a reason to feel positive about bonds in the future, going forward, despite struggles in 2022 and early in 2023. Moving on with our list of what happened on the good side of the equation, as a byproduct of the stock and bond rally, we saw a diversified stock portfolio, 60% stock, 40% bond portfolio, produced its best return since 2019 as well. There was a lot of speculation coming into 2023 that this popular allocation of 60-40 for retirees was dead. It wouldn't work in the future, they said. But at least for 2023, the naysayers were kind of put in check. Another positive, particularly for growth investors, technology investors in particular, is that growth stocks outperformed value stocks. They did it by a whopping 31% for the year. So this is the second best year we've seen for growth over value in history. The only year where growth stocks outperformed by more was in 2019. We'll take a little closer look at that as well. And finally, the last thing to touch on the good side here is, despite some pretty nasty daily swings throughout 2023, volatility as a whole, measured by the VIX index, hit the lowest level since prior to the pandemic. Perhaps what we are starting to see is a return to some normalcy after the pandemic's impact on consumer behavior and government monetary and fiscal policy. So we might start seeing some things start to normalize a little bit, which would be positive just for investor psychology and investor emotions. So let's now take a look at some of the negative things that happened in 2023. So again, while equity investors stock investors did see extremely positive returns in 2023, we have to point out that the large cap rally, the rally in large cap US stocks, was extremely highly concentrated. Within the S&P 500, which is the primary index used to measure US stocks, the 7 largest companies make up about 1/3 of the index. And this is because the S&P 500 index is what's called a market cap weighted index. That means the larger companies have a bigger impact on the total index return. And that could be a positive or a negative thing, just depending on how those top funds or top companies perform. Well, in 2023, as you can see, it's kind of a rather grainy image on the bottom right of the screen. You can see that the top 7 stocks, which are Facebook, now called Meta, Amazon, Apple, Microsoft, Google, Tesla, and NVIDIA, had an extremely positive impact on the index returns. This chart from Goldman Sachs it's updated as of the end of November. But what you see here is that you can see that the combined return of those top 7 stocks were up 71%. That was far, 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 far outpacing the mere 6% returns for the other 493 companies that make up the S&P 500. So what we'd like to see is, this rally in stocks. We'd like to see it broaden out much further than beyond these top 7 companies. I think these top 7 companies saw the majority of their gains in the first part of the year. And one thing all of these have in common is their technology. Technically, Facebook's a communication stock, but their technology, and they all have some skin in the game, I should say a lot of skin in the game, for artificial intelligence. So the euphoria around artificial intelligence at the beginning of the year is really what fueled the returns in these stocks, and that's really what carried the index as a whole throughout the entire year. So some of the other kind of major negatives on the year were that after over a 30-year period, we've had just persistently low interest rates. You know that if you've bought a car or bought a house. But what we saw in 2023 is we saw that the 10-year Treasury hit 5% in October, which broke above this long-term down trend line, which can be an indication that we might have to expect these kind of higher interest rates for a little bit longer. And then finally in 2023, we saw the value of the US dollar weaken versus foreign currencies. And that happened for the second time in the past 6 years. A weakening dollar can be a sign of economic concerns, and while it can potentially be positive for international investment returns, it could be a drag on US stock returns. So it'll be interesting to see if the dollar continues to weaken. So those are some of the positive and negatives for 2023. Looking back, I want to wrap up by reviewing, kind of reminders of 3 keys to investing for retirement in your 401k plan. And that's whether your retirement is right in front of you or whether it's way out on the horizon. The 3 keys specifically for 2024 are mostly around managing emotions. And I just want to kick off, if you're not aware already, guess what? 2024 is another presidential election year. And over the coming weeks and months, as things on the campaign trail heat up into the primaries, people's views on the future might change, positive or negative, depending on who's front running in the polls. It's important. It's not easy, but it's important that you try and separate your political emotions from your investment strategy. And here's why. Just looking at the graph that's here by JP Morgan, what they did is they just surveyed people at different points in time to see how they were feeling about the economy, to see what their views were on the economy. So what you can see is that, in the red line are people that tend to lean Republican or identify as Republicans. The blue line are people that identify as Democrats or they lean Democratic. And when during from 2001 to 2009, George Bush was president, we had a Republican in the House, the presidency. So Republicans tended to feel good. They tended to feel positive about the economy. Well, once beginning in 2009, when the Obama years started, from 2009 to 2017, you can see there's a dramatic shift. Whereas Democrats tend to have, by majority, had a pessimistic view while there was a Republican president. Well, during the Obama years, Democrats tended to view the economy more positively, whereas Republicans had a negative view on the economy. And that all reversed course in 2017 when Trump took office, and you can see the sentiment for Republicans became positive. Democrats tended to think more negatively. So the important thing to see here is that despite how people identified feeling about the economy, you can see what the returns were for investors during those periods. If you were a Democrat during the Trump years, 2017 to 2021, and maybe you said you had a negative outlook on the economy, if you sat out and didn't invest because you felt that the Republicans were going to destroy the economy or destroy the stock market, well, guess what? You missed out on what was a 16% annual rate of return during that period. The same can be said for Republicans that might have felt the same way during the Obama years. Don't want to invest. I have a negative view on the economy, negative view on the markets because who's in the White House. Well, if they sat out and didn't invest, they missed out on 16% annual returns during that period as well. So it's important to just look at the bigger picture, and that despite who's been in office, S&P 500 stocks have returned over the last 30 years have averaged 10% per year. And if you sit out during any period of time, you can miss out on some of those returns. So just reinforcing why it's important to separate politics from your investment strategy. The next thing to reiterate and point out is that you are unique, both in your goals and your emotions towards money and investing. Therefore, you're going to want to review and make sure that your portfolio is set up correctly for not only for your time horizon, but also for your risk tolerance or your emotions towards losses. So what I want to do here is I just want to quickly remind people of the difference between stocks and bonds, which are the two primary asset classes available to you in your investment, in your 401k plan. And the important thing to take away from here is that you can see that stocks over a 1-year period, historically, stocks over a 1-year period have had positive 12-month periods as good as 47%, but on the negative side, stocks have also gone down by as much as 40% in any one 12-month period. A loss of 40% over a 12-month period can be devastating. It can be devastating if you have a very short time horizon. Because if you lose 40% of your account value just as you're getting ready to go into retirement and you're going to start withdrawing on that, well, you just lost 40% of your nest egg. You now may have to work a little bit longer to allow the market to rebound so that you regain your portfolio to a point where you have enough income to support you for the rest of your life. Bonds tend to have, on the short term, bonds tend to fluctuate less. That's why you'll see the target date portfolios and a diversified portfolio for someone with a shorter time horizon might have a little bit more allocated towards bonds, because bonds are going to help mitigate losses in the short term. When you look out in the longer term, however, you can see that stocks tend to have over a 10, 20, really a 5, 10, 20-year period, stocks tend to have higher highs. And that's why if you have a longer time horizon, then the majority of the target date portfolios are going to be allocated more towards stocks. Looking outside, just talking about a time horizon, though, it's important to know what your risk tolerance is. Maybe you have 25, 30 years to retirement. So from a time horizon standpoint, maybe it's appropriate to be more heavily weighted in stocks. But if you suffer losses, over the short term, if those losses are going to cause you some emotional stress and maybe cause you to abandon your investment strategy altogether, maybe just the sheer, just the experience of losses has such a negative impact on you, maybe that's not appropriate. Maybe you do need to have a more conservative portfolio just to keep you convicted in what you're doing. So again, always important to review, how you're allocated between stocks and bonds. And again, here's just the high level. You see stocks, average over the last 20 years, 11%. Bonds average 5.5%, and a combined portfolio, 60%, that 60-40 portfolio we're talking about earlier, has averaged around 9% as well. So that 60-40 portfolio is going to have a little bit less risk, volatility. You're not getting the high highs, you're not getting the low lows, and you're still coming out with a return somewhere in the middle. So that brings me to my final point, which is just to, again, have conviction. I mentioned the word conviction earlier. After setting up your investment portfolio, you're going to be tempted to doubt your decision. There could be a lot of noise around you, whether it's, if you pay attention to the financial news media, maybe coworkers or friends are going to talk about what you should be doing, or maybe they're talking about what they're doing, bragging when things are good, maybe freaking out a little bit when things aren't going so well. The important thing to know is that if you're properly diversified, a diversified portfolio does not always feel good. You're rarely able to brag about hitting the high highs, but the benefits of a diversified portfolio are that you typically are not going to sustain those low lows either. So from an emotional and conviction standpoint, it's important that you understand, despite having a diversified portfolio, you can have periods like in 2000 to 2002, where you're going to lose money despite having diversified portfolio. Diversification does not protect you from losses altogether. It helps minimize losses compared to if you were invested 100% in stocks. So as you can see, you still, during this period as an example, and we can look at other periods as well, 2000 to 2002, stocks were down 40%. Well, that diversified portfolio was still down, but it was down much less. So you have to still experience and expect that you're going to lose money. Same thing happened in 2008. Lost money, but you lost less than what you would have if you were all in stocks. During the pandemic, during Q1 2020, same thing. So I also mentioned don't expect to have the high highs. So you can see, 2009, 2019, a decade following the great financial crisis, that was a great decade for stocks. 351% rate of return. Well, a diversified portfolio was up 237% during that period. So it didn't have as high highs, but again, you avoided those low lows. So it's just important to know that there's more than one way to achieve your goal of long-term success. And as you can see, looking back over this 23-year period, these two portfolios ended up roughly in the same place, just had a different trajectory of getting there. Diversification helped smooth things out in the down years, which again, they helped cushion, help kind of soften some of that emotional blow of losses. So I think it's always good, especially at the beginning of the year, just to remind you of some of these basic tenets of long-term investing for retirement. So that's what I had prepared just to go over today. I guess to wrap up and go through some reminders here. Next month on February 5th will be our next webinar. Same time, 11:30. We're going to be talking not about investments then, we're going to talk about financial planning. So if you had some financial goals that you set for yourself in January, hopefully you're still clinging to them here 2.5 years or 2.5 weeks into the year. Hopefully you're still clinging to them in another couple of weeks when we connect for our next webinar. Because what we're going to do is we're going to talk about how to take those financial goals, how to identify financial goals, but also what you can do to achieve them. And we're going to talk about some tools and some resources that are available to help you. That includes tax planning. It includes, insurance planning. It's the whole estate planning. It includes touching on a little bit of everything, no matter what your goals are. The reminder, feel free to reach out to us if you have any questions. We're here to be a resource to you. We've got, myself and multiple advisors here, certified financial professionals that are here to answer any questions that you might have, whether it's about your 401k or anything else that's going on in your personal life, financial life, that you have questions on. Our phone number, you can send, you can send us an email to schedule a time. Our website has a lot of great tools. And as I mentioned earlier, we're trying to get more and more proactive with our social sites, posting tools and resources for you there. So with that, I'm right at about the 30-minute mark. So that doesn't always happen, but it happened this time. If you have any questions, feel free to use the chat box or the questions box. If not, I want to thank you for your time. Hope you have a great rest of your day and look forward to connecting with you here again in a few weeks.